Do as I say, do not do what the market thinks I'll say, is probably the message that came out of the Fed meet um, 12 hours ago. Now, risk assets thought to be on the back burner. Indian markets have come back a little bit from the lows that they touched in the day, but it certainly seems that for now, the fight against inflation is top of mind and will stay that way. What could the impact, therefore, on risk assets be by and large? Let's get in. Mr. Steve Brice, he's the CIO of Standard Chartered Wealth Management from Singapore, on the show. Steve, great having you. Thanks for joining in. What did you make of the Fed action and the commentary thereafter?
Yeah, so clearly, as you mentioned in the introduction, they're still very, very focused on fighting inflation. And I guess, if you look at the inflation data that's coming out, there's a good reason. I mean, we're seeing the headline inflation coming down, but actually, if anything, the sort of longer term drivers of inflation are actually broadening out and becoming more entrenched. So I understand where they're coming from. And they're clearly sort of between weaker growth outlook, which I'm sure we'll get into, this high inflation, and then obviously the financial fragility that's been shown of late. So it's really been a very difficult time. I guess a dovish 25 was better than a hawkish 0. So from a market perspective, that was probably the least bad option for them to pursue, because if they said nothing, then I think markets may have been even worse and worrying about what the Fed was seeing that they're not. So I think in the short term, that's probably the optimal point. But we think the economy is ultimately going to be too weak to take this extra burden on the chin. So I think it's going to be a bit challenging.
Yeah, and maybe that could be the design, Steve, that there is no other way to get this inflation monkey off the back without nearly engineering a recession so that the demand, which is stubbornly high, goes down a bit, and that kind of helps them bring the prices lower.
Yeah, of course, they'll never say they want a recession, right? They've been very focused on saying they don't want to create unemployment. They want to reduce the number of jobs that are being created. To us, at the end of the day, unless we see a material increase in the unemployment rate, it's going to be really difficult to get that inflation level down to a more manageable level, even from a cyclical perspective, let alone a structural perspective. I think that's exactly what they're doing now. Our concern is that if you look at the yield curve was actually from October last year, suggesting that we're heading into recession. The Fed had already done too much at that point for the economy to sustain over the medium term. Obviously, we've seen rates go up materially since then. So every hike just makes it a little bit more tougher for the economy to keep going and could make the eventual recession more severe. Of course, they can pivot, but they'll be pivoting from a potentially much weaker economic situation than otherwise would have been the case.
So what do you think the risk assets like equities would want? Would the equity markets fear let's assume that there is going to be a recession. Would the equity markets fear that recession, or would the equity markets preempt a potential Fed pivot once we enter that recessionary phase and the inflation pressures show signs of easing?
That's the best question I've had for a long time, to be honest, because that's the crux of the issue, right? I guess the way we look at it is saying that initially the Fed will still be on inflation watch, so therefore we would think that the Fed will be, the markets will be looking at the recession, and saying, okay, how far are earnings going to fall? So typically earnings fall in the teens. During a recession, maybe depends on which time horizon you look at, whether it's low teens or high teens, but that's normally what happens in a recession. So against that backdrop, I think the initial focus will be on that recession and that earnings recession coming through. Only when the Fed starts pivoting from a unilateral focus on inflation to actually a pretty much unilateral focus on growth, which we're obviously a long way mentally from. It might happen very quickly, of course, but mentally we're a long way from that point. Until they focus unilaterally on growth, then I think markets will be weak.
Okay, my final question, Steve. Actually, two final questions. One is two last two questions. The second last question. Asia is probably better placed on growth than the West. But do you reckon that Asian equities too could underperform simply because buyers may fear a US recession-led US market fall and other markets following the mother market, and therefore lower levels for almost all equity markets worldwide over the course of the next 3 to 6 months?
Yeah, so I think the way we look at this is if you look at a US recession that changes the economic cycle across the globe, then normally actually the US market can outperform in a recession, even if it's the original source of that recession. But I think in this environment, we think it's slightly different. So we're seeing China as a very different stage of the economic cycle. So last year was obviously stimulating policy by pushing on a string when mobility restrictions in place. Those brakes have been taken off this year. And so China is going to be, going to do very well, even we believe in the face of a recession in the US. Obviously that will taper enthusiasm to some degree. But in that environment, we think that despite a recession in the US, despite a risk-off environment there, Asia can continue to outperform. And the key thing there is going to be what happens to the dollar. And our view is that the dollar will weaken. So from that perspective, we expect Asia to outperform in the next 6 to 12 months.
Okay. My final question is on India, not as export oriented, if you will, getting in a bunch of FDI flows and manufacturing offshoots as a result of what's happening between US and China. Does India, which had a prolific 2022, have a sedate or a negative 2023? Or do you reckon at some point of time, because the Indian markets are almost off 20%, or not really 20%, but let's say 12 to 13% from the levels that they were at, do you reckon that Indian markets can also have a better second half of the current calendar?
So yeah, I mean, so within Asia ex Japan, which obviously we're bullish and overweight on, we have a neutral weighting on India, right? So we think that India basically follows the regional average, which is still quite positive. So as you mentioned, there's been some cheapness coming through relative to what we've seen historically. India's always been expensive relative to China, for instance. That's not going to change in our opinion, but we do think that maybe China is going to outperform India in the coming 6 to 12 months, but that doesn't mean that we think India is going to do poorly. We're still pretty bullish on those investment flows, also portfolio investment flows, right? So we've seen international investors underweighting India throughout last year. So should that money come back to the market, then that would obviously lead to a stronger performance as well.
You reckon that money could come back, or is it a 50-50 currently?
I guess there's a few overhangs from the Adani situation as well, from a sentiment perspective, but markets have pretty short-term memories. So yeah, as you say, it's a pretty defensive market. So if you want to hunker down in Asia and you're a little bit concerned about the China situation, then I think India will get some of those flows at least.
Got it. Steve, lovely talking to you. Thank you for taking the time out and being with us today. Much appreciate your time.
Thank you so much.
And viewers, thanks for tuning in.